for 7. We are in selection MCQ series for BFM, and today's topic is derivatives in banks. Derivatives means very important, like hedging. Mainly derivatives are used for hedging. So very important topic. Watch till the end. Okay, let's start. Firstly, just I'll tell you these are the two new batches. March 24th starting, 80% off, double validity on Mahapacks. Use the code Y432. More on this later. Let's start. Firstly, I'll explain you few points about derivatives. Why is derivative used in the banking? Then I'll go for the question bank. Otherwise, what happens if I just ask you questions and you answer something, and then I'll answer it the correct one? Then that's not logic. You must understand whatever the topic is, isn't it? So Treasury makes use of derivative products for the purpose of, means why does Treasury use derivative basically? What is derivative? Derivative, understand this. Derivative means derived. It is derived from something. Derivative can be, do you know options? Call option, put option. You might have heard in those all CNBC channel, all these business channels, right? Those are derivatives. So there are various types of derivatives, not only call put. See here, options is one type of derivative. Should I write it over here? Okay, one sec. Options, okay. Second, futures. Futures is another type of derivative. Then there are swaps, okay. Swaps. Then there are FRAs, forward rate agreements, okay. Then there are only forwards. Now this is also separate. Only forwards are forwards. Then there are repo transactions. My God, you name it, you have it. The list will go on. Another 10 can be there. But the point over here is everything, there's a one point common over here in all of these. That is, they are derived from something. Means options are derived from any commodity. Suppose if I am trading in gold options, then the base is gold. If I am dealing in Nifty options, then base is Nifty. Similarly, futures also. Gold future, dollar future, Nifty future, anything I can trade. The base is something else, and based on that, these are derived. Okay. Similarly, swaps also. Okay. FRAs, forward rate agreements. Here only interests are exchanged at the end. Okay. Forwards we already do it in our ABM BFM also, forward contracts, right? In JIB also many of you might have done those forward rates bookings. Okay. Repo you all know, given by RBI, but repo has a different meaning over here. Repo is not limited to RBI lending it to banks. Repo is also concerned about dealing in the secondary market. Repo transactions are dealt in the secondary market also. So you got some point about it? You got it? Basically tell me, derivatives are derived from something that is known as commodity. So they are derived. Remember this thing. Okay. So why are these banks using this derivatives? So basically management of risk, including the risk relating to ALM. So management of risk means what? Catering to the requirement of the corporate customers, whatever the customers are asking for. Taking trade positions in derivative products. Trade positions mean these are for profits. These are for profits. These are not for hedging. These are for profits. Derivatives relate to future value and not to the present value. Obviously, these options, futures, everything is paid for the future date. It doesn't deal in present date transactions. Okay. Means I'll give you one example. Do you want it? See here. Take one example. If Nifty, or let's say Reliance. Okay. Why Nifty? Let's say Reliance. Reliance is right now at, let's say, 2500. Okay. Let's say I'm giving an example. So if I am the options trader, I will say that okay, Reliance is 2500 right now, but I feel this will go to 2700 in next 1 week. I say that. Now if I say that, when I'm saying something, presently it's 2500 and it might go to 2700, that's my view. So for that, if I am feeling that it will go to 2700, there is a premium attached to this present cost. So the premium can be 10 rupees, 5 rupees, anything. So I'll pay that premium and buy this future or call of 2700. So if actually this Reliance goes from 2500 to 2700 in 1 week, what will happen? This 5 rupees call which I had taken, 5 rupees, okay, this 5 rupees call which I had taken, that will grow to rupees 25, means it might go to 20, grow to 25. So 5 times I have earned in just 1 week. If I invest 1 lakh, I've earned 5 lakhs in 1 week. So that is the beauty of these options. That is the beauty of these derivatives. Okay. So that is why banks, this is for the profits basically. This is why banks use derivatives. Also the other option for other point for using derivatives is hedging. Hedging means what? There's, as I told you, I'll buy a call of 2700. This is one position. Second position of mine will be, suppose the Reliance is at 2500, I am expecting it to go to 2700. So I'll buy Reliance right now, share only directly. So if it goes to 2700, I'll earn 200. Okay. But if it goes down, then what? From 2500, I am expecting it to go to 2700. It might go to 2200 also. So to hedge this position means I am expecting it to go up, but if it goes down, then what? To hedge this position, this is known as hedging. To hedge this position, I'll buy a put option, put. Okay. So whenever I am long in any commodity, I'll always buy a put option. So this is known as hedging. Got it, everyone? Clear? Should I move on for further things? Okay. What is a derivative? Derivative is a financial contract that derives its value from another financial product or commodity, say spot rate, which is called underlying. That may be stock, stock index, foreign currency, a commodity, or anything. Okay. Forward contract in foreign exchange transaction is a simple form of derivative. Forward contract means the one which we book. Dollar is right now at, let's say, what, 80 rupees. 1 month forward is 30-40. That you remember all those problems in forex? JIB you did it, right? So remember all those 30-40. Then right side bigger, left side smaller. Then it means what? Currencies in premium. All that thing. Same logic. That is basically forward contract. And when I book forward, I am actually dealing in derivative. Derivative means predicting or guessing the future based on your experience. Remember, it's not the wild guess. Okay. Otherwise, it will be a lottery system. What is the difference between this lottery and this derivative? Lottery means you don't know anything. You are just guessing anything and just putting your bet on it. But in derivatives, you understand the market. You expect something, and you have some experience regarding some commodity. Okay. So that's why derivative is basically derived from some commodity. Got it? It's derived from something. Move on. Understood, everyone? Type yes in the comment section. Everyone, type yes in the comment section right now. Okay. So that I can also see that how many of you are getting the same. Okay. Objects and instruments of derivatives. So objectives and instruments. So what are the major objectives? The major objective that is served by derivatives is hedge the risk. Hedge. Okay. Hedging means, okay, I'll just give you one formula. If I am long on commodity, long means what? Buying at a low rate and selling at a higher rate. If I am long on commodity, then I'll buy put option. Always remember, put option. And vice versa. If I am short on commodity, short means what? Selling first and then buying. If I am short on commodity, buy call option, means to hedge the position. Always remember, this option position should always be reverse of your commodity position. If you have bought the commodity, you buy the put option. Put option is for selling. Okay. And if you are short on commodity, means you have sold it now and you are expecting it to go down and then you will buy it. So that's called as short selling. So if you are short on that commodity, buy a call option, reverse option. Okay. So the major purpose that is served by derivatives is to hedge the risk. Got it? Futures, forwards, options, swaps, etc. are the common derivative instruments. Just now I gave you all these things. FRA can also be added to this. Forward rate agreements, right? The derivatives do not have an independent existence. Here, they do not have. What did we say? They are derived. Okay. So they don't have an independent existence. Okay. And are based on the underlying assets that could be stock index, a foreign currency, a commodity, or an individual stocks. It can be anything. I can put a derivative on gold also. I can put a derivative on agri products. Those are also traded. Okay. I can put a this derivative on carbon emission, greenhouse effect. I can put a derivative on anything. I'll put a derivative on water. Will water exist or after 100 years, 50 years? If somebody says no, I'll say okay, let's put a derivative on it. So that's the meaning over here. You can put a derivative on any commodity. The commodity can be natural or artificial or any man-made. Okay. So before going ahead to the questions, firstly download Adda 24/7 app, everyone. In this app you will be getting the premium study materials plus live classes, ebooks, tests, everything. Okay. Also subscribe to Officers Adda 24/7 YouTube channel. In this channel, number one, you will be getting latest updates on JIB and CIB and all other points. Also, you will be getting free YouTube series on all the topics of JIB and CIB. So subscribe to it, click on the bell icon right now. Let's go to the questions. The payoff of financial derivatives are linked to. Now these are very difficult questions as such. The payoff for financial derivatives are linked to. Means payoff means what? Whether you will be paid in that derivative or not, or whether you lose. Either you profit or you lose. So they are based on what? Securities that will be issued in the future. Securities that will be issued in the future. What did we say? Then it's basically for the will be issued in future. Okay. The volatility of the interest rates. Previously issued securities. Government regulations specifying allowable rate of return. So what is this related to? Derivatives means what? What did we say earlier? Derivatives means it is based on some commodity which is existing. So existing means what? I can have a commodity of dollar also. So which will be issued in future. If something is CBDC is to be issued in future, right? Central bank digital currency. Can I have a derivative right now on this? No. Commodity has not come. So how can I have a derivative on it? Okay. So A is out. Okay. Now see here, I won't give you all the answers. Now you have to judge. I'll just give you one or two hints. A is out. Okay. Let me remove D also. Government regulations specifying allowable rate of return. Rate of return and everything that is not related to any derivative. That is the government policy. Now the question only remains volatility of interest rates or previously issued securities. Again remember, what did I tell you? Derivatives are on the existing commodities. Existing means what? So it is correct. C, previously issued securities means if any dollar is issued earlier, then I can have the derivative on the dollar. If any government bond is issued or any forward currency or any currency is issued, then I can have it on it. Okay. So it's always previously issued securities. Derivatives can be issued only on what is existing. Can't be a commodity which is a futuristic commodity. Okay. Financial derivatives include. What does it include? Let me see now. Stocks, bonds, futures. Oh, let me change this, all of the above. Okay. Let me change this, all of the above. Okay. Now give me the answer. Stocks, bonds, futures, all of the above. Let me see. Is it issued on stocks? Means is derivative instrument. Is a stock a derivative instrument? Is bond a derivative instrument? Is future a derivative instrument? See here, I know many of you feel that okay, yeah, C is correct, but obvious C is correct. But what about A and B? Is stock a derivative instrument? Is bond a Many of you have typed this as D, but D is wrong. The correct answer is C, futures. Stock is a commodity. Bond is a commodity. So both are commodities over here. Commodity. Okay. These are not derivatives. Based on this commodity, I will be having derivatives. But these themselves are not derivatives. Okay. Gold. Gold is a commodity. I can issue a derivative on gold, but gold itself is not a derivative. Okay. By hedging a portfolio, a bank manager reduces the interest rate risk, increases the reinvestment risk, increases the exchange rate risk, increases the probability of gains. Now what is this? By hedging a portfolio means portfolio will include many of the stocks or many of the dollars or anything. Portfolio can be of anything. So what does this manager actually reduce? Interest rate risk or reinvestment risk, exchange rate risk, or increases the probability of gains. Probability of gains here. Hedging is never for increasing the gains. Never. Hedging is always for reducing the risk. So D is out. Reducing the risk is okay, but what to reduce? Now the point over here is increases reinvestment risk, increases exchange rate risk, increases, both are increases. Is hedging done to increase the risk? So what is the answer? Correct, reduces interest rate risk. If this would have been reduces over here, then the answer would have been tougher over here. Now as the options given are increase, 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 none of the hedging is done for increasing any risk. It is always done to reduce that risk. Okay, so the option is reduces interest rate risk. Got it, everyone? Understand one basic. Portfolio hedging. Hedging is always done through derivatives, and it is done to reduce the risk. Reduce. Okay, reduce any risk. It can be reduce risk. It can be actually interest rate risk or exchange rate risk or reinvestment risk. Any risk, if I want to reduce, I can go for hedging. But reduce, not increase. Okay. Hedging risk for long position is accomplished by. Now this is what I have given you in the start of my lecture. Hedging risk for long position. Long means if I am long on any commodity is accomplished by what? Taking another long position, taking a short position, taking additional long and short positions in equal amounts, taking neutral position. So if I am long on any commodity, what did I tell you? If I am long on commodity, let me get the answer from you now. I should be in options or in derivatives. Derivatives, I should be long or short in derivatives. If I am long on commodity, in derivatives I should be reverse, short. Okay. So what is the answer over here? Taking another long, taking a short position. Additional long and short. Now additional long and short means what? You are neutralizing your position. I am buying 100 plus and 100 minus. So answer is 0. Isn't it? So it's of no use. Right? It's called a condor situation. Condor they call it. Condor. Condor means I buy equal amount of long and short. But there you generally lose. Lose means you don't get much in that. So what's the use? You are here for money, isn't it? Taking the neutral position. Neutral means not doing anything. Just sitting idle. So definitely if you sit idle, you won't get money, you won't lose money. It's of no use. So the answer is what? Taking the short position. When you are long on any commodity, you have to be short on the derivatives. Okay. A contract that requires the investor to buy securities on the future date. That requires the investor to buy the securities on the future date. It's called as short contract, long contract, hedge, or cross. Here that requires the investor to buy the securities on the future date means buying security on the future date. That is called as buying securities on the future date. It makes you compulsory to buy that security on the future date. Means what? If I say Reliance is right now at 2500, Reliance is at 2500, and I'll say it will go to 2700. Okay, it will go to 2700 in 1 week. So if I buy a long contract, what am I doing? Do you know? I am saying that okay, I believe that it will go to 2700, so I'll buy a long contract at 2700 after 1 week. Means what? I am telling you, let anything happen, I will buy this Reliance share at 2700 after 1 week. So now, if this Reliance share goes to 2800 after 1 week, If this Reliance share goes to 2800 in 1 week, so what happens? I'm in profit because I booked the contract for what? 2700. But if this Reliance share goes to 2400 after 1 week, then I am at a huge loss because I booked the contract at 2700. I will have to entertain that contract because future contract is such that you can't say no to that contract once you have booked it. It's like buying the land. If you book a land at some rate, you have to buy that land. Otherwise, what happens? Your margin money which is given is gone. Okay? So that's why. So it is what? Short or long? Only two things I'll give you. Okay? Short or long? A or B? So answer is definitely long. Which makes you to buy the securities at the future date. Okay? Got it, everyone? So that's why any contract to buy is known as long position, and to sell it is known as short. Okay. Now let me come to this code Y432. See this code Y432 will give you 80% off on the website, and in the app it will give you 81% off. In this batch for March 24th starting, okay, all the 4 subjects are covered: ABM, BFM, ABFM, BRBL, everything is covered. Number 1. Number 2, remember numericals, objective questions, case studies, everything is covered over here. So definitely go for it, I would suggest. Okay, how to use this code? Let's go to Adda 24/7. Let me show you live. Okay, go to Adda 24/7. Okay, now what are you seeing? You see over here, see this. What do you see now? You see basically the JIB and CIB front page itself. Okay, click on JIB and CIB over here. See this JIB and CIB front page. See this JIB and CIB. Click on this. Then click on CIB 23. You are in CIB, so click on CIB. Okay. Click on the batch, March 24th batch, English one. Okay. Click over here. Now you will get the details of the batch. Means 24th March starting date. How many days of the week? Then what all the subjects are covered, what all are the study plans. So everything you'll get it over here. 2 interactive classes. Importantly remember, you can ask the questions there and then itself. Recorded videos are available, so you can definitely ask the questions immediately in the class and get them verified also, get them cleared also. Okay, click on view offers. See, fees is 23,999. Click on view offers, put the code Y432, click on apply, see what happens. 23,999 reduces to 4,799. Such a huge discount you guys are getting, so go for it immediately. Okay, also I would suggest go for the Mahapacks. In Mahapacks you are getting this 15 plus batches per subject, and that also double validity in the offer only. See here, it's not always available. In the offer it's available. Click on JIB and CIB Mahapack. Okay, then click on CIB ka Mahapack. Once you click on this, you will see the details again. The batches, 15 plus batches per subject, you see this. Then similarly others, you can read it at your ease. Okay, importantly I'll tell you, see this 35,996. click on view offers, put the code Y432, click on apply. Look at this. So 35,996 reduces to 7,199, and that also 80% off. Such a huge discount you guys are getting, and this is an investment for lifetime. Go for it right now. You won't get this double validity offer every now and then. Also you won't get this 80% off. Okay, so go for it. I'll be back tomorrow with another series. Till then, bye.